Good morning. This is Chris Robinson, Robinson Ag Marketing, with Wednesday mornings pre-opening comment. Well, lower overnight, not massively lower, but certainly not what we're looking to see if we're trying to carve out a bottom. September corn hit 388 and a quarter. If you look at the long-term continuation charts, and it's not rocket science, you go back to the old lows. The downside risk here from 390 failing is 360. Now, just because I say that's the risk, it doesn't mean that's where we're going to go, but 360, 355, that is, if we don't see something turn around, it's going to be a magnet because these markets tend to go to old lows. Um, I don't want to get super aggressively bearish, but I do want to protect that possibility. And what am I looking at? Well, you can go back to the continuation chart, which is a longer term chart. August of 2024, 360 and a half. And we're trading 389 and a half right now. So there's 30 cents worth of risk there. How do you defend 30 cents of risk? In my opinion, you don't spend more than 6 or 7 cents. Ideally, five, six, seven. You don't want to spend 20 cents to protect 30. That's silly. But I would absolutely positively do something here if I've got corn in the bin. And that is just the technical risk. Again, I can't say this enough. People always get things confused. Because I say it's a possibility and because it's an old low, I'm not sitting here promising we're going to go there. I just think that if I was long, and I'd say, okay, how much heat could I possibly take? It's the old low. That's just the way these markets work. They tend to go after old lows. The same thing. If we're having a big rally, they go after old highs. We saw that 3 years ago after the COVID thing. We just kept going higher, higher, higher. It was old high after old high after old high. So that's the risk there. D's corn, again, I would definitely protect as close to 410 as I could. Um, Spot beans lower overnight, 978 three quarters in August. November beans back to 1006. I've talked before about the importance of 1004 and just $10 as being a big level to protect. And what's the risk there? Well, the risk is the September low. Excuse me, not the September low. The April low during the first tariff pitch when we slid down there. So 1070, and then if we keep going, it's December's low, which is about 1060. So that is 40 or 50 cents. Is that worth protecting? I don't know. Some people think it is. Some people don't. That's your decision. But 50 cents worth of risk, you don't spend more than 12 cents, in my opinion, to defend it. September wheat lower across the board. Chicago down 3.5 at 526 and a quarter. KC um, down a penny. Still holding in at 515 and a quarter. We'll see if that can hold. Hopefully it does. And then Minneapolis sitting there right at 575. So now we're gonna have to see 575. If that doesn't hold, it opens the door to 550. Flipping over to the cattle, that's a market that just seems like it never ever wants to turn around. They keep coming forward. Cash keeps holding firm. The only thing I would concern myself with if I'm involved in the protein complex, first of all, you've got to protect these prices. I don't care who you are. At some point, this thing's going to turn, and we're going to correct. Um, and that's when you're going to say, "Well, Z, why did I do something?" So keep your puts on the books. They don't have to be expensive, and you can protect a lot of revenue. The hogs, on the other hand, they look like they may have been turning here. Um, I thought that we'd get one more run up to the contract highs. We failed pretty hard in the last 4 or 5 days. I thought if we couldn't take out, just for instance, look at April of 2026, we needed to take out 89 cents. There's a possibility now that you may see some profit taking. The funds are pretty long. The lean hogs, you're starting to see a little bit of uh, pullback here in the some of the cash markets, some of the cutouts and things like that. So I would be, if I'm a hog producer and I don't have any puts on, I would get some puts on because this thing may turn. And we all have seen, hogs trade much more violently than a lot of other markets, um, up and down. So if you don't have anything on, defend this revenue. There's some good uh, profits there to be taken care of on paper. So that's about it. The outside markets, what's going on there? Well, let's see. Stock market still hanging near their all-time highs, trading 44,000, almost 45,000. September S&P 64.17, up 4. So the stock market's holding in there. Dollar's holding in there. Crude oil Can't take out 70. Like 70 is going to be a big level for crude oil. That's something I would continue to watch. We're trading right at about 69.80. That's a pretty good move there. And why is that important? Well, we talk about how crude oil can influence the whole math problem for ethanol. So I'm watching crude oil carefully. It came down and tested 60, 65. Looked like it was going to fall out of bed. The little trend line there held. If you follow my letter, you know I had a little trend line in there. Sometimes those old trend lines are worth their weight in gold. And we'll see. I think if crude oil takes out 70, probably opens up the door to one more run up to that high there that we had right in June. Granted, that high was influenced by what was going on in Iran, but this seems like it's more a bit of money flow there, and also just the idea that the economy may be better than people had imagined. So that's a key level, 70 bucks in crude oil. Watch that carefully. Um, I'd love to see something where the whole world wakes up and says, "Oh, we need to own commodities." If that's going to happen, it's going to have to start with crude oil. So that's it for the day. Give me a call anytime. Chris Robinson, Robinson Act Marketing, 312-638-8868. If you're working with somebody now, that's great. Uh, if you're looking for someone maybe to look at your problems with fresh eyes, or you want to take a look at my approach, give me a call. We'll talk about it. Have a good day.